Hello and welcome to Investment Insight. Before we begin, be sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So if you look at the recent financial headlines, you'd probably think every Western investor out there is running away from China as fast as humanly possible.
Oh, absolutely. The narrative right now is basically, total panic.
Right. But looking at the actual data,
Hmm.
the truth is actually this really fascinating story of, well, we're calling it a capital split.
Yeah, a capital split is the perfect way to describe it. It's not a simple mass exodus at all.
Exactly. And that's our mission for this deep dive today. We're going to explore why long-term money is trapped, why short-term money is actually rushing back in, and how you can spot the difference between a catchy, terrifying headline and the actual flow of billions of dollars.
Because if you just read the headlines, you completely miss the mechanics of what's really going on behind the scenes.
Yeah, so let's start with the biggest headline, the one everyone's talking about.
The Ray Dalio rumor.
Yes, the Ray Dalio rumor. So word on the street is that this legendary investor supposedly got completely fed up with China and sold all his shares in his firm, Bridgewater, in 2025. It sounded like a massive, dramatic exit.
Right, it makes a great story. But recent analysis really clarifies what actually happened there. Did Dalio sell his remaining shares and step down from the board in July 2025? Yes, he did.
Okay, so that part is true.
It is, but it wasn't a sudden, rage quit over China. This was actually the final step of a multi-year succession plan. They started planning this transition back in 2017.
Wow, 2017. So this was almost a decade in the making.
Exactly. You can't just hand over a massive hedge fund on a Friday afternoon. It takes years. It wasn't a dramatic China exit at all.
It's kind of like, think of it like a really famous chef retiring from their flagship restaurant, right?
Yeah.
Just because the founder hangs up his apron, that doesn't mean the kitchen stopped cooking.
Right.
And it certainly doesn't mean they suddenly hate the food.
Yeah.
The management just changed hands.
That's a great analogy. And the hard numbers actually prove that Bridgewater is still very much cooking in China. Looking at the data as of 2026, Bridgewater China is operating locally with over 60 billion RMB in assets.
Wait, 60 billion?
Yeah, 60 billion. And in April 2026, they even maintained a positive outlook on Chinese equities. So a firm managing that much local money with a positive outlook is definitely not packing its bags.
Okay, I hear that. But I got to push back a little here because according to the research data, Bridgewater dumped about $1.4 billion of U.S.-listed Chinese stocks like Alibaba and Baidu in the second quarter of 2025.
Yeah, the ADRs.
Right.
Yeah.
Selling over $1 billion of those stocks, doesn't that look exactly like running away?
I get why it looks that way, but we have to understand the difference between a U.S.-listed Chinese stock, an ADR, and actual mainland Chinese assets.
Okay, break that down for us.
So selling those ADRs was entirely about reducing very specific U.S. listing risks. Especially now, with President Trump in office, the trade rhetoric is intense.
Oh, totally. The geopolitical tension is high.
Exactly. Holding a Chinese company on an American exchange carries the risk of sudden delisting or heavy tariffs. By selling those ADRs, Bridgewater was just stripping out the geopolitical risk of the U.S. exchange.
Ah, I see.
Yeah, it had nothing to do with abandoning China entirely, which is why their local mainland funds are still operating normally.
Okay, so Bridgewater hasn't left, but someone else definitely has. If we want to find the real exodus, the data shows we really need to look at private equity.
Yes, private equity is where the real freeze is happening.
According to recent Financial Times analysis, the top 10 global PE firms, we're talking giants like Blackstone, KKR, Carlyle, they made exactly 0 new public equity investments in mainland China between January and July of 2026.
Literally 0, which is staggering.
Yeah, 0.
Yeah.
That's a massive drop. Back in 2021, those same firms did about 12 deals in that time frame.
So why the sudden freeze? Are these companies just bad businesses now?
No, the core issue actually isn't that Chinese companies are suddenly bad businesses or even that the prices are too high. The problem is what we call the exit discount. The exit discount.
Right. In 2025, those same 10 mega funds had 0 complete exits from their Chinese portfolio companies.
Meaning they couldn't sell them.
Exactly. The whole private equity model relies on buying a company, holding it, and then selling it for profit a few years later. If you can't sell, the model breaks.
So for anyone listening, imagine this real estate analogy. Imagine someone offers you this gorgeous, massive mansion at a 50% discount.
Sounds like a steal.
Right, it sounds incredible. But the catch is, the city tells you they might never give you the permit to sell to anyone else in the future.
Which ruins the investment.
Exactly. It doesn't matter how cheap the mansion is if you can't ever cash out. Private equity in China right now is basically a financial roach motel. The money checks in, but it just can't check out.
That's spot on. In finance, we call this duration risk and liquidity risk, with Chinese regulators actively blocking deals like, remember when Meta tried to buy that AI firm Manus for $2 billion?
Oh, yeah, I remember that.
Regulators blocked it, so now PE firms can't guarantee they'll be able to sell their investments 5 to 10 years down the line. They just can't take that risk.
Okay, so that makes perfect sense. But that leads to a really obvious question. If geopolitics and regulations are making things so scary that private equity is completely leaving, why is other foreign money actually returning to China?
That brings us to the core concept of what's happening right now. Capital polarization.
Capital polarization.
Yes. Investability in China today depends entirely on one thing, how fast you can hit the sell button.
Wait, really? It just comes down to speed?
Basically, yes. If we look at the data, global public equity funds, so stock market investors, they actually increased their average China weighting from 1.4% in early 2024 to 1.8% by February 2026.
Okay, so the stock buyers are leaning in while the company buyers are running away.
Exactly. And it's all about liquid versus illiquid assets. Public equity is highly liquid. You can buy a stock in Hong Kong today, and if things get weird, sell it tomorrow.
Right, you just tap a button on your phone or trading desk.
Yeah, and investors love this right now because Chinese stocks are cheap. Plus, they offer a nice, safe diversification away from the whole US AI hype bubble.
Oh, the AI hype is everywhere right now.
Away from the tensions in the Middle East. It's tactical, but private equity, that's illiquid. Your money is locked up in a factory or a startup for a decade.
So the big takeaway for you listening is that you can't just label China as bullish or bearish anymore. Those simple labels are dead. You have to ask yourself, how long is my money stuck there?
Precisely. The duration of your investment dictates everything.
But this brings up a huge potential problem. If Western dollars from, like, massive pension funds and Wall Street are completely freezing their long-term investments, isn't the Chinese tech sector just going to starve to death without that cash?
That was the assumption, but recent data shows the exact opposite is happening.
Really, they aren't running out of money.
Not at all. Between January and May of 2026, Chinese VC and PE investments actually skyrocketed by 60% compared to the previous year.
Wait, 60% up?
Up. They hit around $916 billion.
Almost $1 trillion. But we just said Western money stopped. So where is this cash coming from?
The money is now coming from local RMB funds, state capital, and local governments. The nationality of the capital has completely changed.
Wow. Okay, so it's internal money. What are they buying?
They're flooding money into what they call future industries. We're talking strategic sector space, quantum computing, nuclear fusion, humanoids, and AI.
So it's kind of like, okay, think of it this way. It's like a startup losing a strict bank loan from a Wall Street bank.
Right.
The bank wanted quarterly audits and safe returns, but then they pull the loan. But immediately, the startup gets funded by a wealthy, overly enthusiastic local uncle.
I love that. A wealthy local uncle.
Right. He doesn't care about quarterly audits. He just wants to beat the neighbors across the street and have the coolest tech.
Yeah.
The money is there, but the motivations are completely different.
The motivations are radically different. And honestly, it's creating a warning sign. Because this state-driven money is pouring in with a massive FOMO mentality, fear of missing out, it's actually creating a bubble.
Really? A local bubble?
Yes. Some startups in these sectors are seeing their valuations double in just a few months, not because of profits, but just because local governments are outbidding each other.
So we have this bizarre situation where old economy companies, like traditional real estate, are heavily discounted and struggling.
And new strategic tech companies are dangerously overpriced. It's a completely dual market.
That is wild. Okay, so that's what's happening inside China. Let's look at the final piece of this puzzle. If those top 10 global private equity funds aren't spending their billions in China, where on earth is that Wall Street money going?
It's rapidly shifting. According to recent analysis, all that money is flowing directly to Japan, India, and Australia.
They're just bypassing China completely.
Completely. We're seeing massive new Asia funds being raised right now. For example, EQT launched a $15.6 billion fund, and Blackstone has a $13.1 billion fund.
Those are huge numbers.
They are. But the kicker is they are capping their China exposure at around just 10%.
Just 10% in an Asia fund that used to be like at least half of the portfolio, right?
Oh, easily. But they are actively making a trade-off. They are trading China's geopolitical and exit risks for Japan's improving corporate governance, India's massive structural growth, and Australia's institutional stability.
So they're just buying peace of mind, essentially.
Exactly. But, and this is a big but, I have to warn people not to blindly follow this herd.
Okay, what's the risk there? If everyone's going to India and Japan, shouldn't we go too?
Well, just saying China out, India and Japan in is super risky. Think about the volume of money. With all those billions of dollars rushing into India and Japan at the exact same time, it could accidentally create massive valuation bubbles in those countries too.
Oh, I see. It's like everyone rushing through the same narrow door at once.
Exactly. You might escape the trapped money problem in China only to massively overpay for a company in Mumbai just because every other private equity firm is trying to buy it too.
That makes a lot of sense. So to wrap up this deep dive for everyone listening, the story of China's economy right now really isn't a simple "everyone is leaving" headline.
No, it's much more nuanced than that.
It's a story of a great financial split. If you have liquid cash that can move fast, China's basically a massive bargain hunt right now. But if you have long-term money, it's a locked door.
A locked door that Western firms are refusing to walk through.
Right. And meanwhile, local state money inside China is aggressively pumping up their own sci-fi tech bubble.
Which leaves us with a really fascinating final thought to chew on. We're essentially witnessing the deglobalization of finance.
The deglobalization of finance. What does that actually mean for the future?
Well, think about it. For decades, money just went wherever it wanted. But if the world permanently splits into separate, walled-off capital ecosystems, like a U.S. ecosystem, a Chinese ecosystem, and a Middle Eastern ecosystem where technology companies can only really be bought and sold within their own borders,
Yeah.
then what does it even mean to be a global company anymore?
Wow. That really changes the definition entirely. A totally fractured financial world. Well, that is definitely something to think about. Don't forget to subscribe and hit that like button.